It's a freezing crypto winter. No two ways about that. There's so much insecurity in the market at the moment, nobody's even really sure what the right questions are to ask, never mind in a position to find the correct answer. Will Bitcoin be the only survivor when all this is over? And how on earth did CETs blow up FTX? Join us as we attempt to answer these and other pressing questions. First up, will the crypto ecosystem collapse? Before we even start, let's look at the players involved. Both Binance and FTX are cryptocurrency exchanges. They make it possible for customers to trade digital currencies. The two process the vast majority of crypto trades around the globe, and this is according to CoinMarketCap, which tracks industry data. One of the world's largest exchanges, FTX, was headquartered in the Bahamas and run by Sam Bankman-Fried. The company has spent vast sums to get US legislators to make crypto-friendly laws. Binance, the world's largest exchange, is in the hands of Changpeng Zhao, a Chinese billionaire. The company has no official headquarters and functions predominantly outside the USA. Binance was an early FTX investor. Both companies built and grew their businesses on the back of risky trading options, and it pays to note that these aren't legal in the USA. Jeff Booth is a Bitcoin proponent and author, and he firmly believes the crypto ecosystem will give in, predominantly because it's centralized. But, and here's the caveat, not Bitcoin. The narrative that the bulk of the crypto ecosystem will collapse due to its centralization is reinforced by the downfall of FTX and a host of other centralized finance platforms. Booth also believes that FTX and Celsius, to name only two examples, did nothing more than replicate the traditional financial system, and in the process, they also duplicated its inherent flaws. In other words, they used a skewed blueprint. In an interview with Cointelegraph, Booth said most of crypto was trying desperately to rebuild a financial system based on manipulation and centralization. He argues that decentralized platforms based on peer-to-peer alternatives to traditional financial services are bound to fail, and they will fail because they're built using protocols that boost scalability while sacrificing security and decentralization. According to him, the only secure and decentralized cryptocurrency that has a chance to survive and be the base layer of the financial system of the future is Bitcoin. We're going to discuss where the idea for an FTT came from in the first place. That's coming up in a moment. Stay with us. Now, what is a crypto exchange token and how did it blow up FTX? No exchange token represents a claim on a centralized crypto business, but these tokens can have utility. A key role in the downfall of the FTX crypto exchange and Alameda Research, its affiliated trading firm, was played by FTT exchange tokens. This is according to Ian Allison from CoinDesk, who raised the first doubts that eventually led to the collapse. There is another aspect to the FTX fraud, and FTT may well have been at the core of it. They served as notional collateral, even though they're worthless, for client funds FTX used to help bail out Alameda. It is important to understand exactly what tokens are and what role they serve for the issuing exchanges. And also, it's important to know how they should be treated under the standards of modern accounting, and also how they advance the decentralization agenda of the crypto industry. So, let's answer the last question first. By and large, exchange tokens are not decentralized. If anything, they have the opposite goal. All they have as an incentive is to stay with the same centralized exchange. When you hold an FTT, it can earn you rewards and maybe early offer access, or you can get discounts on trading fees. There was a lot of chatter on Twitter, but despite that, the FTT token did not distribute any kind of FTX platform revenue share or assign holders governance rights of any kind, and this is the case with most exchange tokens. To get a deeper look into the fraudulent mind of Sam Bankman-Fried and his business dealings, keep watching. Although the fraud was technical, it eventually came down to clever accounting, perhaps in the same vein as the Enron scandal 20 years ago, and we're getting to that shortly. Okay, but where did the idea come from? The FTT is actually in contrast to a series of ideas that may actually have been its inspiration. Around 2016 or 2017, a lot of chatter surrounded utility tokens that could be used to pay nodes and incentivize decentralized computer services. This term seems to have lost its spice, with the only examples being stored: the BitTorrent token now under Tron management, and perhaps Helium, the Wi-Fi node project that is now also in trouble. The greatest appeal of utility tokens is the fact that no legal regime is necessary for the enforcement of property rights or to claim a place in the capital stack. That's partly because there isn't a capital stack, but also because its value comes from services directly connected to the blockchain. Exchange tokens and their value, but contrast, rests on a legal regime that in many cases doesn't even exist. Most and probably all exchange tokens are issued by offshore concerns. FTX and Binance, for instance, are registered in the Bahamas, a notoriously light-touch regulatory haven. The first to launch was Binance. As will all businesses, success breeds copycats. This is according to the co-founder and director of Research Katie Talati, OKX, UOB, and others all launched tokens, and it became standard operating procedure. FTX launched in the latter half of 2019, around the same time their token was launched. Here's the kicker though. Exchange tokens can serve as an instrument to raise money, much like equity, but it doesn't mean it is that kind of instrument at all, or that it even resembles equity. They aren't a part of a capital stack, and there's nothing to claim in bankruptcy. There is a complete absence of governance. The irony here is that these tokens are issued by entities that lack strong regulators and well-enforced property rights, yet they trade and behave a lot like equity. If you think about their value, compare it to a discounted cash flow model. That said, there are many inputs that simply cannot be modeled. We're going to see whether the lessons learned from FTX will actually be applied in the accounting world. To see where this will go in the future of crypto, keep watching to the end. So, how did this influence Bankman and his fraudulent finances? A key element of Sam Bankman-Fried's grift was a low-flow, highly fully diluted value token. Only a minute portion is traded publicly. The price for the public was assumed to apply to the portion owned by FTX itself, and that was hundreds of millions of dollars. This makes sense. Think about the equity value that the founder of a startup hangs on to after the venture capitalists grab their slice. The big issue with the FTT tokens on FTX and Alameda's balance sheets was that they didn't track to reality or standard equity accounting practices. When companies account for handling stock bought back from public markets or their own equity, this is not added to the liquid assets or valuation estimates. Instead, these are tallied separately as treasury stock. The simple reason for this is that the company's equity is only a reflection of its total value, not a part of it. When you add the stock you own to your bottom line, you're essentially acting like a snake eating its own tail. This was the elementary accounting deception that eventually became the ticking time bomb. Bankman-Fried was using FTT as loan collateral between Alameda and FTX, and it seems other related entities too. There are frightening similarities between what he did and the shenanigans that went on at Enron, with paper shuffling to hide debt and supercharge its own value. And finally, will this lesson impact the way crypto accounting is done and monitored? FTT was central to the most spectacular crypto blowout ever. It pushed crypto leaders to think about clarifying their position on exchange token accounting and accounting for similar in-house assets. The CEO of Binance, Changpeng Zhao, went to great lengths to make it clear that Binance has never used a BNB as any form of collateral. The CEO of Ripple, Brad Garlinghouse, also said his company doesn't count its vast XRP trove in the balance sheet. FTT is not the sort of asset that should ever be used in the way it seems it was, and no reputable or truly independent entity would have ever accepted it as collateral for a loan or considered it as an asset in any way. The bulwark for enforcing that norm is the experienced crypto investors, and they're also the ones that stand to lose their shirts when they don't. Many projects have a token on the balance sheet, and that should just be crossed out. And that, folks, is how we end this video. Thanks for staying with us, and remember to hit the follow and like buttons. Please keep your eyes open for our next contribution. Thanks again, and we'll see you next time.